as an industry, and I say this to founders, is you're one of one. Your company ABC is one of one. You are not diversified, right? If your outcome is zero, that has a really big effect on you, positive and negative. Like there's gonna be lessons learned, but ultimately, like most people think that'll be a negative impact. I think that's a fair assumption. Your venture fund, your partner at the fund, whatever you want to kind of refer to it, you're one of 20, 30, 40, 50. Like no one wants to see failure, but it's part of the business, right? You become,
we see it all the time as VCs. Yeah.
You become desensitized to it. So if you look at the venture model, right? Unfortunately, failure is going to happen. You need to make up for the failure. So the ones that succeed need to succeed big.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Jay Levy on the program. He's a co-founder and partner at Zelkova Ventures. He's a seasoned early stage investor with 17 years of experience backing transformative SaaS companies like Help Scout, Clout, Crimson Hexagon, and Customer.io. Pretty amazing. He's also a Techstars mentor and a trusted advisor to many founders scaling from 0 to 1. From his beginnings in finance at Morgan Stanley to building startups and now investing out of Miami, Jay brings sharp insights into what makes early stage companies win. Thanks for coming on, Jay.
Thanks for having me. Looking forward to the conversation.
Yeah. So you've been investing out of Zelkova for 17 years. What originally pulled you into venture after your early days at Morgan Stanley and founding Uconnections?
Yeah. So I was first employee at Uconnections. Didn't found it, but second employee out of 600.
Basically a founder.
Uconnections was actually started in college. Kind of my early story is I actually grew up in South Florida, where I now live again after 20 some odd years in New York. But I had started making websites back in high school. My options for jobs were like go work at the bagel shop at 6 a.m., which I tried for a few weeks and was like, I don't like getting up at 5 a.m. to ride my bike to a bagel shop. So I started designing some websites. And this was like, in some ways, interestingly, kind of similar to days like today now when it comes to designing, which I'm sure we'll get into. But this was when you could use what was known as a Wig See Wig editor. What you see is what you get, along with some programs like Paint Shop Pro to make some websites. And I actually wound up building some websites while I was in high school for some publicly traded companies and some other actually large companies. This was super early, right? So this was, we're talking probably 96, 97. So most of the sites are, I call them billboard sites, just pure advertisement with maybe a email submission form.
They got the header ad at the top.
Exactly.
And like some information and links that you can click on, very Yahoo-esque.
Yeah, I had about 15 clients. I liked the recurring revenue portion of it, which was the hosting. There used to be a company called ThinkHost back in the day where, I'd pay $50 a month to host these websites and charge each client $50 a month, right? So, making $700 a month, with the shared infrastructure. So that's probably what got me really interested in recurring revenue models as a whole.
Very powerful.
From there, while still in high school, the city that I lived in, Carl Springs, had reached out. They wanted to build a platform, a website, to connect with the local college students, local high school students and middle school students. So they wanted calendar events, happenings, things of that nature. Today, we'd probably call it like a blog. Like that term didn't exist back then. So myself and two others got internships at the city. We built out this site, global attention from it. It was kind of crazy, but this was like, very early days where you could get quick attention, right? There weren't as many websites out there. So we got a lot of notoriety. There used to be a guy still around, Leo Laporte, who had a tech TV show. We were on that. So we got a ton of press. Then I went up to Rutgers, and these guys who were starting this internet for college students, kind of similar theme, reached out to me. I was the second hire. We grew Uconnections to about 500, 600 employees. I think we raised in total about 12 million. So this is, give me an idea of timeframes. This was, let's see, 1990, 2000, 2001, right around kind of the tech bubble, right? Built out the offices. We had green fur on the walls, the pool table. Back in the day, you had to have either co-locate servers, you have to build your own racks in your offices, which we did. Funny story, we ultimately failed, fast forward, but I'll never forget the day that I believe it was Citrix knocked on the office door because we had leased a essentially storage device. I don't know how many megabytes, gigabytes, what that storage device is, but that's probably something today that'd be $20 a month online. This was a several $100,000 purchase. We financed it. We stopped paying the bills.
You ran out of money, right?
We ran out of money, right? Or, we were prioritizing. Repo Man comes knocking on the office door to roll out the NAS device and kind of, we wiped it clean.
Literally take your servers away.
He literally took the servers away from us. So I got to see the birth, the life, and the death of a startup from my dorm room, which was incredible. We had built online food ordering in 1999 and 2000. So I went to Rutgers. We had the grease trucks there, which were these trucks that you get these incredible sandwiches at 2:00 in the morning after a few drinks. And we equipped them with BlackBerries back in the day, or we built a fax server where we could, to the local pizza shop, you could go on a website, order your pizza, and it would get faxed in because these places didn't have computers. They didn't have internet connections yet. So we built all that stuff. And this was, 99, 2000. I think Seamless launched in like 2005, right? So we were really ahead in a lot of ways. But, we were 500 to 600 employees. The markets had a downturn. The venture fund behind us didn't want to make any capital calls from their LPs. And once you have a ship going like that, with that much capital, that much people, it's very hard to pivot. It's much easier to pivot early on when you're a nimble team. When
you're on a railroad track and heading in a direction, and it's hard to switch.
At that point,
rails.
you're kind of like a cruise ship, right? You can't turn, you can't do anything quick. So ultimately, we failed. Incredible experience for me. Again, I got to do this all from my dorm room. And then I started to intern at Morgan Stanley, ultimately graduated, went to work for Morgan Stanley for 6-7 months and quit. This was 2003, 2004 time. So New York City at the time was still getting over September 11th and kind of the downturn then. And I remember the day I quit, and I was in operations. So I felt like I was like, I hate to say it, like going to go nowhere there. Like it was like, I could kind of see my path 30 years from now, looking at my colleagues, and I'm like, either I figure out how to get onto the other side of the house, right, the front of the house, or like I'm capped at this managing director's, and he's going to be here for the next 15, 20 years. Like, where am I really going to get? And I've always been a little bit of a risk taker, very entrepreneurial. So I walked into his office, I quit. He was furious, like absolutely furious with me, because, they did invest a lot in training me. And well, with that said, I was making more as an intern per hour than I was a full-time employee. So, I don't feel so bad. But I quit and joined the same guys from Uconnections. They were launching a financial service consulting company, and that had a better outcome. Sold that. And then at that point, I was starting to go to the New York tech meetups, which back in the day, the tech meetups in New York tended to be 30, 40, 50, 100 people, small gatherings, demos of products, for lack of better terms, very dorky. This was before like venture was cool, right? So like when I graduated school, everyone wanted to be a banker. Like it wasn't like going into venture. It seems as if it went from...
Yeah, same. I'm a child of the 90s as well. Wanted to work on Wall Street, the whole deal, yeah.
Yeah, you wanted to be a banker. If you could get into Goldman, that was a gold standard. Otherwise, you go to Morgan or Citi or somewhere of that nature. And then it went from like being a banker to all of a sudden going to hedge funds. That became the new hot thing for graduates. And then from there, it became venture. So this was way before venture was a cool thing in New York. Started looking at some companies. My partner, Larry, had exited his company. We started to invest together, and 17, 18 plus years later, we're still doing it. Started very clean tech, green tech focused. We're not clean tech, green tech focused.
As one does in the late 2000s, yeah.
Yeah, and we really realized a few things. One was there was a lot of money going after the space, right? There was a lot of science experiments, and there was a lot of people smarter than us. So we quickly realized we were like the dumb ones in the room, and this probably doesn't play out well. With that said, we did make an investment in the space. Locus Energy ultimately wound up being a very successful company for us. So we did, the one of one at that time was really good, but we did have enough self-awareness to know that this wasn't for us. So we really went to something that I've always been interested in, is helping businesses succeed, right? Investing in tools, platforms, ideas, and people that ultimately want to help businesses do business better, whether that be more sales, more cost, more efficiency, et cetera. Like, at the end of the day, that's what SaaS products are as a whole, right? When you're selling enterprise or really any level of SaaS product to businesses. So that's what we've been focused on. Obviously, like a lot of questions about what does the future look like, which I'm sure we'll get into. It's kind of the story of founding Zelkova. We're now 120, 130 companies we've invested over the years. We're also in over a dozen other venture funds and incubators. We have exposure to kind of the broader asset class also.
Wow, so much to unpack there. So I want to go back and revisit a few things and ask some questions because you've had a lot of great experience. Let's go back to Uconnections and this food delivery startup that you guys had at the time. Like, what did it kind of teach you about investing and about timing, and what kind of lessons did you kind of take away from those experiences?
Wow, really jogging my memory here. So Uconnections, I think a lot of it was about don't scale too quick, right? We've scaled too quick. And I've always been a believer that companies going to have their own cadence and their own heart rate. And while you can incrementally improve that, you can't force it when it doesn't exist, right? And that's, I think, a lot of what we saw was like, venture as an industry, and I say this to founders, is you're one of one. Your company ABC is one of one. You are not diversified, right? If your outcome is zero, that has a really big effect on you, positive and negative. Like, there's going to be lessons learned, but ultimately, like, most people think that'll be a negative impact. I think that's a fair assumption. Your venture fund, your partner at the fund, whatever you want to kind of refer to it, you're one of 20, 30, 40, 50. Like, no one wants to see failure, but it's part of the business, right? We
see it all the time as VCs. Yeah.
You become desensitized to it. So if you look at the venture model, right? Unfortunately, failure is going to happen. You need to make up for the failure. So the ones that succeed need to succeed big, right? So I think that was a big lesson where how do you enable the most success among the most amount of companies? Because I think that's more fun also. It's more fun to, see a company be a 3, 4, 5x than a 0, to see people make wealth, have something to be excited about. So I think the Uconnections really was like, we went big, we went quick. We were also super dependent on venture, obviously, right? We didn't have a revenue model. That was a good one.
Is this sort of like a precursor to Facebook? In your mind, you're kind of being like, we could have been Facebook?
One of my partners likes to say that.
Yeah.
I would never say that because I'm much more humble than that one guy is. Yes, we were order food online, internet for fraternities and sororities, so events calendar, chatting. We were coupons. We were this was in the days of like the portal, right?
The
internet portal was big. So Student Advantage was one of our competitors. They were backed by Amex. So yeah, it was I don't remember if we did the kind of photo sharing, you could put photos up.
A little too early for that. We just didn't have the bandwidth for it.
Right. So, but it was we wanted to be Yahoo for college students. We had search, things of that nature. Right. And, I remember, so we had a local network of students who would work for us and, give out t-shirts. And, I remember what one of the growth hacking, which that term, I don't think even existed, but now I'll use it.
No, not until the 2010s. Yeah.
Yeah. Go into the computer labs and set the homepage to uconnections.com. We used to do, which the colleges hated, right? So instead of being, the Rutgers.edu homepage wherever they wanted, we'd send, every day someone into the computer lab to set the
change
homepage.
Yeah. That's funny.
So I'd say the lesson was you can't force it. Find a revenue model that works and build a sustainable business with real unit economics, because we just didn't have that, unfortunately.
Yeah. And then let's talk a little bit about your thesis and how it's evolved over time. I mean, what disciplines and verticals have you maybe invested in the past that you've kind of shied away from now? You mentioned clean energy, obviously. It's where you started, almost 20 years ago. But how's your thesis evolved over time? What fund number are you on? And how has what you do changed?
So we're unique that we haven't built what I call like a platform VC, right? So we don't have a whole team who's doing your, finance, helping you with social media, PR, et cetera. So we've been able to keep kind of overhead low, which hasn't forced us to raise more funds for management fees. So we're also unique that the GPs are some of the largest LPs in the portfolio, in the fund itself. But I'd say the biggest thing is we focus on people, right? I tongue in cheek say it's 97% people, 2% market, 1% product. It's probably not that drastic, but it's directionally correct. So that's been our biggest thesis. The other piece is we tend to be, for lack of a better word, cheap. I'm very valuation conscious. Early on, when valuations on kind of early deals, seed deals, kind of the first $2 million worth of capital call, because when we started, the term seed wasn't used, pre-seed definitely wasn't used, but the first $2 million of capital, right? A $2 million round was a Series A back in the day, when we started. That's what that was called, right? It was a price round. Convertible notes were used for their purpose to bridge companies. Then they migrated into being an instrument to fund companies that looks as much like equity as possible. And then obviously safes were introduced. But for us, it's all about the people. And we very much have focused on backing the right people at the right price. Because we at one point back tested our portfolio where most of our valuations were sub 5 or around 5 million. We back tested one of our funds against the valuations of the day and age of 10, assuming the same outcomes, which I think is relatively fair. The M&A prices didn't move too much. At some points they did, especially once we got into kind of the pandemic eras. Our returns were like cut by 70%. At the end of the day, this business is about returns. LPs want to see returns. And that's also changed, right? So if you look at up until a few years ago, we had a very long period of time with zero interest. People and funds and investors were searching for yield, right? When your alternative was zero, the risks and the returns of venture look really darn good, right? Now that you can get yield in other places, venture is not as attractive as an asset class. So we're very much right now thinking through all these things, right? Because we're kind of on both sides of it, right? We're GPs, but we're really LPs and we think like LPs. Okay? So we're looking at like, where are the best places to deploy? Not about, GP returns, but about LP returns. So I think that's super unique about us is kind of, we're only on our third fund. We have sat out periods of time because valuations are too high. We say no all the time. It's like, thank you, but you're too good for us. It's kind of an easy no as a whole.
I'd love to kind of dissect that a little bit, right? Because valuation is a hotly debated topic amongst VCs. A lot of VCs have this discipline where if I'm a pre-seed, I don't go over, call it a 6 or 8 cap. Entry price is just too high. Beyond that, blah, blah, blah. And then, other investors have different definitions of what even a pre-seed is or what a seed is. So what are some, let's talk about the easy no's, and then we'll take some easy yeses on the flip side of that.
I mean, the easy no's are like the deals where you're like, okay, there's a $20 million pre. It's 2 founders that just got out of an incubator. There's 5,000 of MRR, most of which is friends and family type of relationships where
other people in the incubator they sold to.
Exactly. They're not self-aware, right? Like, there's a whole list of like characteristics kind of we look for in founders that, happy to get into. But those are like the easy no's, right? Where it's like, okay, like first time founder, they're not self-aware. They're,
what are some telltale signs or questions you ask founders to see if they're self-aware?
So, and this has really changed over the years, right? So for us, it's kind of like dating. You just got to give it time, right? And get to know them. A lot of phone calls. I'm still big on person. I'm not sold on the whole remote first way of building companies. So for us, it's having dinner, sitting down with them. I tend to really like to dive into product. I tend to really dive into sales and marketing, especially I think that's changing incredibly right now, both product and sales and marketing. But we look for kind of like their approach. Like, how do they take feedback? How do they respond? How do they deal with introductions, right? What's the arrogance meter? Like, how high is that? Because ultimately,
the ego to ability ratio is another way I've heard
ego to ability ratio. I like that one. Yeah. Because this is someone we want to work with, right? Like, I've had founders who we've invested in who have been successful and had good outcomes, but I hated working with them, so I regretted it. And I've had founders that have struggled and had zeros, but loved working with and have backed again, right? So for us, this is unfortunately, and maybe this is changing also, but unfortunately, historically, we're in the services business. We're backing people, especially at the early stage. This is not about the models. I mean, I look at the models because I want to see how self-aware they are, right? Are they going from 0 to 300 million in 3 years? Because that's great. And we all wanted the exception, but we got to underwrite the rule.
Yeah, that'd be a very rare outcome.
But you see it, right? But you see that in
right.
decks, and you're like, okay, that's a red flag.
Kind of, yeah, or at least a yellow flag. Like, oh, okay, great projection there, but how do you get there? How do you actually get there?
Yeah. So I think those are, from founders, it's just about time, like getting to know them. And on the reverse, like, I hate to say it, like you're one of 30, 40, right? As a founder in our portfolio or another fund's portfolio, right? Whether someone owns 1 share or 100,000 shares, 1%, 10%, 10 basis points, if they're one of your investors, they can kind of make your life miserable, right? They've got rights, they got a mouth, they got a keyboard. And I always say there's 3 types of investors. There's investors who write a check and add value. Check, awesome, right? There are investors who write a check and leave you the heck alone. Check. Fine. You need some of those. Then there's investors who write a check and drive you crazy. That's what you got to avoid, right? So as a founder, like, find a few good investors who are going to write a check and help you, right? Find a few good investors who are going to write a check and leave you alone, but you're going to keep them updated. You're going to keep them, no surprises. You're going to do good investor relations as a founder, but try to avoid the ones that write you a check and are going to drive you crazy. And every founder has at least one of those, unfortunately. They tend to fit, and this is in my experience, a very similar stereotype, a retired executive who has too much time on their hands, hasn't done too many of these companies, and is looking to like get really involved and thinks they know it all, and thinks because they worked at some Fortune 500 company and did well, those skills translate to like early stage startups. That tends to be the investor that drives, at least the early stage, drives the founders crazy.
That's really good advice. Yeah, for
Probably
founders
gave
out there.
too much away there on that one, but
Yeah, no, that's great.
That'll somehow
watch out for
come
that
back
archetype
one day.
Yeah, so I guess as a founder, what kind of questions would you ask your angel in this case to try to flesh that out?
Again, I think it's time. I think it's get on a plane, meet with them, have them come meet with you. We have forgotten about FaceTime and how important it is to like go to dinner, break bread. If you both play pickleball, go play pickleball together, like, get that common bond, right? Together. And then it's a little back channel, right? That's one of the benefits, I think, of some of the incubators. And I'm kind of big fan of Techstars. You can get the institutional knowledge of the network, right? So back channel these people, but ultimately also go with your gut, right? Like usually, like what I found is the founders that have said to me, "Oh shoot, this person's really driving me crazy." There were some signs, and they didn't go with their gut because they were so anxious to get the money in. I get it, like it's a trade off, but intuition is a real sense. Like that's something super important on both sides, especially on the venture side and the startup side.
So what's your check size in the latest fund? We're just trying to get a sense of how much of the round you're taking in these pre-seed and seed.
Yeah, actually 200 to 300, and then reserves 2 to 3 times. So what we typically look for is a company raising $1.5 million to $2.5 million. Well, we have a bit of a barbell approach, and I'll explain on this fund. But kind of at the earliest stage, we're looking for companies that are raising $1.5 million to $2 million. We're gonna do about 20-25% of that round initially. Typically, what we found, and again, this is I think changing right now, but typically what we found is the company will needs that capital to really get most of it to get a build the product, right? So maybe they'll get a little early customer traction, but very little. They'll need to raise another $1.5 million, right? $1.5 million, too. At that point, hopefully us, along with the other investors and whoever our co-investors are super important. We'll step up quickly, right? And it's kind of a win-win, right? Founder doesn't have to go to market to try to fundraise. They don't have to potentially have the fear of not fundraising. It's a devil you know versus a devil you don't, the people that have already invested in you. And we'll write another check for 2, 3, 400,000 because we now had a year to 18 months of working with this founder, and we understand kind of what we've got, right? And valuations will be probably more justifiable than they were in the first round. So we kind of, some ways, probably dollar cost down based on where the company is. And that's really where we kind of dive in. And then, Series A follows we'll do. I don't really like to do the Series A. If we have to, from a signaling effect, we will. But our returns are going to be generated from the first two. I'd rather put another 250 into a seed deal, or pre-seed deal, I should say.
Yeah.
Than that.
How do you think about reserve strategy? Because you said you reserve 2 or 3x.
50%, yeah, 50 to 60%. Of the capital,
of the fund.
Right? Not every company's going to get it, right? Some companies we're just going to be like, nope, this company isn't hitting any metrics. They can't build. The leadership's not there. They don't have the characteristics we're looking for. All right, let's write this one off now. Some companies will sell, right? And then some companies will go out and kill it and go raise at a crazy high valuation where it's like, we're happy, right? Like, go do it. Like, so, we've found reserving 50% enables you to back the ones at a higher level that you want to do.
Out, and with a 200 or 300 check with a safe, you're getting all the side letters, you're getting your pro rata, you're getting probably major investor rights on the
major
conversion.
Investor right. Yep, that's we ask for observer rights on the board if there's a board. I'm a big fan of companies setting up a board. I don't want your job. It's not about replacing you. I got a pretty good life.
So have you taken any board seats, or you tend to just do
official board
roles?
seats? Yes, and I almost always regret it, but board observer seats I really like, and we've been doing board observer seats pretty much from the beginning. The reason why I like board observer seats, it's kind of all the benefits without the headaches, right? Like I don't really, and I don't really want to get into like stock grants and the minutia around that. Like, it's just not how I think. It's not that exciting to me. So, leave that for someone on the voting board. If a board at an early stage company can't agree, the company's kind of screwed anyway. Like, it's very rare at an early stage company that everyone's not on the same page. And then as an observer, you can kind of play an interesting role because you have a different fiduciary duty. The question is, what fiduciary duty in some ways to the company? And that's a little bit gray. But the many times I've played a role where it's almost like mediator moderator between some board member and a founder, where like, get them to come together and like not fight, because that happens, right? Like, investor relations is tough for founders, and investors have egos, and sometimes founders have egos too, and they kind of clash. So big fan of the board observer seat. We typically will take those, and I'll get on a plane. I'm the guy who gets on a plane, comes to the board meeting, laptop is not out, pen and paper, taking notes, and like listening. Right? Like, to me, like, sit there, listen, engage, turn off the distractions, and have a meaningful conversation.
That's amazing. So it's you and another partner. So how many checks are you guys writing, or how many board observer seats will you have at any given time? Do those roll off over time?
Yeah, they roll off. I mean, there's a time and a point where we don't, unfortunately in this business, new money speaks. Like, that's just how it works, right? So there's a
some
point,
big tier one comes in, writes
exactly,
a $5 or $10 million check.
Andreessen comes in, like, I'm not on the board anymore. I'm fine with that, right? Because frankly, I've probably picked up one or two. So there's typically any time 8 or 9 observer seats kind of active. So it's manageable. And also, the nice part about the observer seats is you have less homework. I mean, there are a few that I've been asked to be on the comp committees, again, reluctantly, but I do it. But less homework to say. So you can scale yourself a little bit more there.
Yeah, fascinating. So how many checks per fund per year?
Depends on the year. We probably write first time checks versus follow on. First time 4 to 6, follow on probably 3 to 5.
Okay, yeah, so pretty concentrated.
10.
Yeah, so you're very careful.
We're doing about 25, 30 deals per fund is where we tend to be. Right now we're kind of figuring out what the future looks like. We think we're early in kind of coming up with our predictions around AI, but we're not as bullish as we were in the past about venture as a whole as an asset class. We're super bullish on building companies, but how does, I mean, I'm happy to get into it if you want.
Yeah,
but
for sure. That's how,
so
existential for me.
So I kind of touched on it earlier. Historically, companies have raised X amount of capital, let's just say $2 million for a second, right? And they've used,
do you want to call it a 10 post safe kind of deal?
Whatever, right? It doesn't. The first round of after friends and family, which doesn't seem to really exist anymore.
I see a lot of pre-seeds in the 500 to $1 million range now. Right, 5 on 5, or
even that number, right? Like 80% of the initial kind of first few $1 million tends to go to product development, right? So historically, what it was you raised some money. You built a product. Historically, a long time ago, you hired engineers here in the U.S., right? Then we shifted
servers
to hiring engineers overseas, right? India. Then it shifted to Philippines and Ukraine and some areas.
How do you feel about outsourced engineers when you kind of see that on the deck? Yeah, our team's in, name your country overseas, and you're like, okay, are they full-time employees? Are they a dev shop?
So I think there's a big difference in a dev shop and full-time employees. I think it's important, actually, but the key is to have the core talent on the founding team, right? But I also think this is changing in real time. So historically, it was like, okay, raise a bunch of money, hire people in the U.S. Then it went to raise a bunch of money, hire some really good people in the U.S., but hire a lot more people overseas to kind of augment that, which was important. And now I think it's getting to have some smart people on the founding team and use these AI products to really help you accelerate build. So where I think, and what we're focused on, is we're getting to a place where companies should be able to go from 0 to, I don't even want to say minimum viable product, but pretty good viable product. PGVP, just made that one up on the spot, right? Pretty good viable product. A lot quicker and a lot cheaper, right? So now they've raised $2 million. Right?
I basically want to invest in a company without revenue at this point, and that's probably changed in the last 5 years.
So let's say they did raise the $2 million, right? They raised the $2 million. Instead of now spending 1.5, 1.6, 1.7 on build, they could be spending $200,000 or $300,000 on build, right? To get this pretty good viable product out in market, right?
pay for it and buy it. And,
Look,
some have even bootstrapped it maybe at that point if you have 2 or 3 founders putting in sweat
exactly.
equity.
Right. You might not even need there. Then you've got all this other cash. Well, now you can invest in sales and marketing, right? To actually get those customers and to prove it out.
Which used to be the Series A, but now it's become the seed.
Well, if you don't need to use the money for the build anymore, you got to use the money for something else. But then there becomes an interesting paradigm here. Now you're starting to see some incredible AI tools around sales and marketing. So how much money do you actually need to launch a company if you still think you need a core amazing team, right? Who understands how to use these products. But I don't think, there used to be a day, and there still is, where you'd ask a founder how they're doing, and their response would be, we have 40 employees. I didn't ask how many employees you had. Or we have 80, right? There was a badge of honor in people, right? We're now looking and thinking like, okay, how do you build companies much more efficiently? And then what does that mean for our business, which we can get to separately? But we're very focused on how do you use tools to build products, get them to market. Look, even if you're building on, a tool that can't scale to 1 million users, right? Well, that's a high-class problem to have to rebuild at that point, right? You've done the hard part, right? Building is not the hard part. It's convincing people to use or buy what you've built, right? That's when failure happens. Very few companies, look, there's some fail because they couldn't build the product. Okay, you got the Theranos of the world, right? You got you got some medical technologies that have real scientific breakthroughs. You got energy technologies, real scientific breakthroughs. But there's very few SaaS platforms that can't be built. It's all about selling them. So now if you can build it really cheap, really quick, really easy, get out to initial customer base, even if you got to scrap the code in 18, 24 months, who the heck cares? You've got product market fit at that point. So then the question becomes like, how does that affect our business, right? Do they need us anymore?
Well, especially on the growth stage and late stage.
So at first you're like, okay, like, does it replace early stage, right? Or do they just need a few $100,000, or to your point, a few, really scrappy founders who want to, work hard and figure all these tools out? Can they do this without any capital? Or just do we go back to the day and age of friends and family and fools and companies raising 200,000 or 300,000?
Friends, families, and fools. I haven't heard that before.
So do we go back there, right? Where you raise a few $100,000, you kind of, work 80-hour weeks and you build something amazing. And then you could argue, okay, you get a bunch of traction. Well, then you say, okay, well, then you go raise a big round. But then you say to yourself, wait a second, if I got the machine working, why do I need to go raise the big round, right? So the question I have is where, for especially in the SaaS world, right, where will venture capital be in a decade? Now, with that said, maybe we'll have to start investing in other areas, right, as an industry, and not be focused on software, but I think there's a lot of big questions right now facing venture. And, if you would have asked me this question a year ago, my response on AI was a bit different. My response was, it's a steroid, right? So the example I gave is like Barry Bonds, great baseball player, right? Took steroids, really great baseball player, right? Like, I'm not a great baseball player, played as a kid, right? You couldn't give me steroids and make me a great baseball player, right? So my view on AI was, what it was going to do was take a great programmer, great developer, great writer, great product person,
entrepreneur,
right?
Yeah.
Make them better, right? Take a good one, make them great, right? Bad one, probably not move the needle too much because they're not going to know how to leverage it. I actually think it's going to replace more people than we thought now. So it's,
and it's taking the bad people, people that are below average, and everybody thinks they're above average, but there is a bell curve distribution of people that's fleshed out in the science, right? And so if research shows so far, at least in like call center experiments and stuff like that, that it takes the poor performers and makes them at least average or better. So it's actually lifting the floor, basically, maybe of what's possible and what people are capable of in terms of execution and their abilities.
But at what point do we still need that, right? Like, it's becoming so much easier. Look, I can go on to some of these platforms, the Lovables, the Replits, like some of the more...
I miss Lovable, by the way.
So, and build something cool, right? But I can't do the last mile, I call it, right? Like, I can't make sure the infrastructure is correct. I can't make sure, I don't really know how to deploy it fully, right? So I can get myself 50, 60, 70% the way there, but I still think there's
I'm actually seeing startups that literally do this, right? So they're taking these vibe coded entrepreneurs and they're starting to solve their problems, right? So it's like this like virtuous cycle of knock-on effects, these second and third order effects of entrepreneurship, where I've literally seen decks come through like, hey, we're solving this replit lovable, cursor kind of problem where all this code's being shipped, but it's not, performant and SOC 2 compliant and, not scalable and extensible and all this stuff.
So the question I would have is like, okay, but at what point, this is moving so quickly, at what point are they doing that? They obviously are looking at these companies. How do you ensure we can go from 0 to live, right? In an easy way, right? So is that a point solution that's ultimately going to be replaced by the platforms themselves? There are firms out there that will build on Bubble for you and, full stack sites for 30, 40 grand. And then for a few grand a month, you can have a full-time developer on Bubble. Now, does Bubble scale? Like, are there risks there? Probably. But could you use Bubble to get, a pretty good product? I think so, right?
At least
and we're seeing that, right?
Pretty good viable product, PG, VP.
Yeah. So for us, we're very much thinking like, what does this mean, right? Does this mean that, funds should kind of go a bit more in the incubation model, right? And bring on some great people that can help with the last mile, right, of deployment, right? And, build their own stack of development tools they're using to kind of
I see a lot of founders say they're not going to raise after the pre-seed or seed.
Right.
They basically want to achieve escape velocity from there and never raise another round and take more dilution and keep 70-80% of the company.
Yeah. So I think the industry is rapidly changing, and we're kind of creating potentially our own demise from an industry perspective, right? We're funding a lot of the developments of these great platforms.
Or we could see it like a reshift, right? Like anytime a wave of automation hits our economy and the industrial revolutions, you get kind of various second and third order economic effects. One might be a compression at the mid and late stages of VC, where there's fewer rounds, but they're really, really big. Or maybe they're more deeply technical, like SpaceX or whatever, Neuralink. And then you get a proliferation of early stage and incubated models. Lots of pre-seed, lots of micro VCs, just lots of, this thousand flowers blooming, small early stage rounds.
Yeah, I think 100%. I mean, it's super interesting, and then we're just talking dev. You got the same type of tools coming out on sales, marketing, and operations too within companies. So we're excited, and we're looking at potentially some acquisitions of companies that are struggling, that haven't kind of taken an AI forward approach to building their business. I think a lot of companies right now are focused on how do you build AI into their product. We're actually very focused is how do you use AI to build your business, right? And those are the founders we're excited about that are looking at this as an opportunity and not, fearing.
That might be a really good question to ask founders. How are you using AI to operationalize and scale? You can learn a lot. A question I'll ask is like, wait, what's your favorite productivity tool? And I'll learn a lot from that.
Yep.
I ask that a lot of my guests, actually. That's a very typical end of podcast question.
My favorite productivity tool is probably text message. We used to be email.
Yeah. I sometimes think ChatGPT slows me down because now I'm processing everything through it. And I have all these various prompts and automation around Airtable and stuff, like sending prompts and docs and text back and forth all over the place. And I'm like, it's funny. I'm thinking like, in the time it took me to drag these files into ChatGPT, give it my prompt and return something, I could have just looked through the files.
And then you always have the question, is it right? But we'll get there. Like, that's my biggest challenge. So I play backgammon, and I have a backgammon instructor that I see. He's
oh wow, you're serious?
Yeah, I like
have an ELU kind of like ranking system too, like chess.
There's a rank. Well, interesting enough, there's a platform called Extreme Gammon XG that Travis Kalanick just bought. So he's a backgammon player, and he just bought XG. Essentially all the analysis. It's this old school. I had to go out and buy a PC. I use Mac. I had to go buy a PC because it only runs on PC. But I've started putting in boards into ChatGPT, and it's actually pretty accurate. It's not 100% there. And yesterday I was with my coach, and
you using O3 or
yeah. And I was with my coach yesterday, and he's old. He's got to be late 70s, early 80s, and he's now using ChatGPT because he's kind of a world champion. He kind of look at a board, know the right move, know all the calculus behind it in seconds. It's pretty incredible what he can do. But he's now using ChatGPT, and he's apparently building a platform with ChatGPT and some others to essentially teach backgammon. And you're like, wow, this guy's like late 70s.
So funny. I just looked at an education startup this morning. And it's like a low margin, teach people tech educational startup. I was like, how did I even take this meeting? And they're kind of walking through the deck. And I'm just thinking in the back of my mind, ChatGPT, ChatGPT will just I can go do all of this right now with ChatGPT, like all the stuff you're showing me.
And he said the same thing. He's like, look,
Yeah.
he's like, he's retired at this point, but like my living, his side hustle is teaching. He's like, everyone's talking about how I'm going to be replaced. And I'm like, you're like 80. I'd worry about other stuff than ChatGPT replacing you right now. But from that perspective, but he's using it. He's building a platform with a few other guys because they have acknowledged that this is the future of education for, backgammon. But that probably goes to poker, right? Probably goes to Worlds of Warcraft, all these games, right? Like all education can go there. And I was just shocked when he's like, walked through all the questions. And he pointed out the 4 that answered correct. And the one he's like, this is not perfectly correct, but pretty good. And I think that's
could use those Meta Ray-Ban glasses. Just be looking at
what? That's
cards.
Interesting. They're probably going to wind up being banned from the tournaments. I mean,
oh yeah, 100%.
Yeah. Poker, like that's
because you'd have this like perfect assistant giving you all the pot odds, just perfectly calculated.
I mean, could you imagine poker, and I'm not a poker player to speak of, but poker with those glasses on, recording the people, recording the body language, the tells, and then
last time that person did that, they bluffed. Yeah.
I'd love to see that. Can someone build that and ultimately?
I'd love to look at that. I'm sure somebody's
run around Vegas with it for a few months, make a lot of money, and then
before they catch on,
before they get caught
10 years from now, it'll be a movie with Matt Damon in it.
Yeah, that'd be pretty cool actually to see.
So, what disciplines and verticals are exciting you now, and how has that changed over the years? And we've talked a lot about AI's impacting.
Yeah,
it sounds like it's impacting your thesis and philosophy as well.
I mean, verticals. we tend to be a little more horizontal when it comes to companies. So we try to invest in tools that can apply to a lot of different verticals. Marketing tech has always been big for us. Sales enablement's been big. Compliance, a little bit of security has been big. FinTech has been pretty big. It really comes down to tools that help business do business.
These are almost like areas, if you stop and think about them, that are always disrupted and reinvented every 5 or 10 years with technology.
Yep, 100%. And what I think is a little bit changing now. So, we've seen a lot when it comes to, give an example, tools for customer service, leveraging AI, right? That's super hot right now because it makes sense. And we've invested, we're invested in Help Scout. That's a customer service platform. We've invested in others in the space over the years. The difference now, in my mind, for a lot of these companies than it was 10, 12, 15 years ago was those companies that launched 10, 12, 15 years ago, we're replacing nothing. We're replacing email. We're replacing CDs that you bought at Office Max, installed software, right? And they've got customers now, right? And the customer is ultimately important. And I'm not as convinced that all these companies that are building, AI-driven help desk software, right, are going to be able to capture the customers. I think they're underestimating the ability of a lot of the existing players to innovate and keep their customers. So I think the land grab is a little bit tougher for customers, for companies that are just trying to bolt on AI into a accounting platform, into a customer service platform, into you name it. I think it's a little harder because they still got to get the customers, right? And the bar was so low 10, 12, 14 years ago for these tools that getting the customer wasn't hard. I think it's harder now, because they're developing these tools in a lot of ways. That Help Scouts had to change their revenue model because of AI, and it's done very well for them. But that's a change they decided to make because we built AI into the platform, and AI ultimately should help a company be more efficient with less people. Well, if you're I don't care if you're customer service or anything, if you're in a seat-based revenue model for your SaaS company, right? And you've got AI that you're building in that's supposed to reduce the number of seats that are necessary. You're kind of cutting your own revenue unless you charge more per seat or change your revenue model for more of a usage-based or value-based revenue
outcome-based, yeah. What is the job I'm doing for you, and how do I price that, and what value do I capture?
Exactly, yeah.
Now we have a AI company, CollectWise, in the portfolio that uses AI to collect debts. And growing super fast, basically that's how they make money. It's a contingency basis. I go collect the debt and I take a percentage of that debt I collect. And so it's basically no risk for their customers. So acquiring customers is very easy. It's like, hey, you're already paying people. overseas in these call center farms to go call people and try to collect these debts. We just do that with AI now.
How are they doing it? They're doing phone calls?
They're doing phone calls, text messages, emails, multimodal AI debt collection.
And they can be, they can ensure it's compliant, regulatory a lot better because they can control it, right? Because you can't always control it.
Never has a bad day. Yeah.
Right.
24/7.
You don't have employees who are getting yelled at and screamed at by someone on the other end who now you got employee
You know, what's funny
problems.
is I had that job in college. I worked at VoiceStream, which is now T-Mobile. And VoiceStream, as you know, and T-Mobile, terrible service. And I worked in the collections department. So when you'd go to make a phone call, I'm like 20 years old, you know, in college, my part-time college job. I'd get the incoming, hey, like you haven't paid your bill. You need to pay your bill to use your phone. That was a real fun experience. So I know how bad. I have a lot of empathy for that.
It's got to be a horrible job, right?
Horrible.
To do. I mean,
I cried tears of joy when I left that job.
I hate to say it. Like, one of the things that I hope actually comes out of some of these AI platforms is better customer service, right? I just don't think companies get how frustrating it is to consumers. Some of the customer service that's out there, especially when kind of first line of defense is international. They don't have the ability to actually make decisions. It can be super patronizing. It's not empathetic, you know. So I'm hoping that that's an area that next time you've got to call whoever for customer service, it's a much better experience because they're empowered and they're culturally aware, and it could just be a computer.
Yeah, we just backed another company that builds AI to basically auto-translate your voice and inflection and accent to match. So by the time you do talk to a representative, they could be speaking Hindi in India, and it just translated the voice to perfect, you know, American English.
Was this the Techstars New York company?
Yeah, I think so. Yeah.
Yeah, I think I know the company you're talking about. It was pretty cool. I saw the I saw the demo. It was pretty cool.
Solo founder, always risky.
Yep.
You know.
Yeah, very very cool.
PhD in CS from Stanford, so you make that bet.
The voice stuff scares me. I mean, that's like
tough.
You know. By the way, did you
space.
see they caught the guy who's doing like this grandparent scam? So,
I don't know. Tell us about that. I don't know what that is.
So there's this like scam that'll like call your parents or your grandparents and tell them you're in a car accident or arrested, and you need money immediately. And it was,
so they somehow got your voice, so they're deep faking your voice?
No, it wasn't even the voice. It was like
the text message.
Oh no, they did. Sometimes they did have the voice. Yeah, sometimes you would hear a voice of like, "Hey, grandma, like I need some help," but it would be someone else, and like, you know, they'd figure out ways to get the cash, and it was a huge scam. And they caught the guy. It's like, looks like a professional from Canada. Like, it wasn't like, you know, the guy's emailing, "I need money," from Zimbabwe or wherever they email. Like
some guy in Canada.
What if this guy, like, I mean, that's pretty ingenious to build. Horrible, but pretty, like, it took some like creative thinking. Some, you know, he built a whole company around this. What if this guy actually put that, you know, his ability to good use? He wouldn't be going to jail right now, I guess, or whenever he's, you know,
crime doesn't pay. Just apply all that entrepreneurial energy to solving somebody's problem for a profit. It's so much better.
Right. Debt collection.
To create suffering and misery and steal people's money for a profit. That's
crazy. So the voice stuff scares me.
Yeah, it's kind of crazy.
It really does.
So I want to talk about remote work. You said you're a fan in-person companies, but I feel like every startup now is remote first. So maybe you could talk through that. Once your companies go in person, and is that a hard no for you? Yellow flag? Like, what are your thoughts on that?
I don't think it's ideal. You know, we've had one company pre-pandemic. We had one company successfully make remote work well. And if you ask that CEO, his response would be, it would have been a heck of a lot cheaper for me to open an office and hire everyone in one location, right? But that company was investing in quarterly offsites for the entire company. That gets pretty expensive, right? Time, money, etc. when you have 150, 200 employees to do, right? To keep that common bond and that gel. They also did things like first month or two was at the kind of home office, which they had a small base. I just think there's, and again, maybe this is all disappearing with AI, but like, put aside AI and technology for a second. I think there's a benefit of someone sitting in the next room, being able to walk over and, you know, see what they're working on, or bring your laptop over and work together. Or if you're a salesperson who's new at a company, overhearing what another salesperson is saying on a phone call, right? Picking up, that's like, osmosis is real, right? Learn through osmosis. So, you know,
it's just funny because literally the podcast before you, Chris Dyer, episode 186, you'll be episode 187. He discussed remote first work and he's basically a consultant. He was one of the first to do it back in like 2009, and we were just talking about all the ways to do it. So to do it successfully.
I just think it's so there's kind of the answer, right? All the ways to do it successfully, right?
Yeah.
You've got to invest in all this ways.
You got to be thoughtful with it,
right?
Yeah.
Versus like, now I get, we're in an office, we got an office, we got, you have meetings, you can overhear. And I think for younger people, for community, I think for learning, I think it's super important, right? So I think it's ultimately, I wonder how many founders are going to take a step back and say never again for remote if they don't succeed. Right. But again, we like to point to the successes. So we're going to point to the successes and ignore all the failures that potentially were created by, the fact that you didn't have a coherent team that was working together. You didn't have people who you used to know if someone was interviewing for a new job. They came into the office dressed a little bit nicer and they went out for a long lunch. Oh,
or they left
what Steve's
early.
doing today,
Yeah.
right?
Yeah.
You don't know that anymore. Right? Like we hear these stories of people working for 2 or 3 companies full time. You couldn't pull that off,
There's the guy that was working for 8 YC backed startups recently.
So I'm old school with it. But with that said, I'm also focused on how do you leverage AI in the most places you can in building a company. But yeah, I like to see the whites of people's eyes. It gets back to meeting with founders, and I think there's something fun about that, and enjoyable. Or I enjoy relationships and people.
Yeah. Same. That's why I do the podcast, because I'm just sitting here in my pajamas, an hour east of Sacramento in Northern California. And it's the way I get to connect with people out here in the sticks.
Granted, we're in a shared workspace. Granted, I think I'm the only person on the entire floor today, but that probably says more something about South Florida than anything and the work.
Well, it's also 4th of July, so people are probably coming back in a little late from the weekend. You've backed many iconic early stage SaaS startups. What are some consistent patterns you've seen with the best founders at the early stages?
Customer first. I mean, they kind of live and breathe and are obsessed with kind of what the customer is saying. That's super important to us. With that, they also don't wait for perfect, right? They ship product, they get feedback. They're not afraid. In fact, not only are they not afraid, they want to hear negativity. They want to hear what's wrong, right? Because they don't want just to be told it's great. They want to get real feedback. So that customer first is super important. I think that kind of dovetails into self-aware, right? They know what they're good at. They know what they're not. They know how to hire. Charismatic. At the end of the day, being a founder is about attracting talent, good talent around you, so they can bring on the talent. They can tell a story. They can tell a true story. They're believable. They're truthful. So hiring is super important, right? And they realize they can't, self-aware. They can't do it all, right? And they realize their shortcomings, and they're willing to ask for help, right? So that's kind of being able to put together a team. With that said, I think decisive is an important one also, where, if they've made a mistake, they reverse decision on that, right? Quickly, right? They don't wait, especially a small company, right? They hire quick, they fire quick, and they're kind of they're always kind of one step ahead, and they're also kind of moving in multiple streams at the same time. So if they've got a round of funding closing, they're not waiting for that round of funding closing to start hiring if they want to fill a position or getting ready to onboard a software. They're doing all these things kind of multifaceted together. So I think for founders, that's kind of the patterns we've seen is for some of the best ones. The self-aware one, I think, is also challenging when it comes to sales and marketing, right? And not valuing sales and marketing. I don't think that is looked at as much of a skill as something like coding might be, right? I don't know Java. I can't write code, right? But everyone thinks they can sell, right? We'll meet with founders who obviously can't sell. They don't present well, but they're really good at what they do, right? Maybe they're very product focused, but they think they can sell, right? Because it's not something that's a hard skill that, I can sell this product. So that's something that's really important to us that we're very much focused on is founders who are self-aware of what they're good at and bring in co-founders, bring in executives who fill those gaps.
Yeah. So on the flip side, where do these early stage founders fall short, even when they look promising at the beginning?
Okay, so let's use an example. We invest in a company, and then 6 months later, we screwed up, right? This isn't the right founder. What have we found? I think is kind of the question. They think they can do it on their own. They haven't been able to hire good talent around them, and they're so fearful of someone telling them their baby is ugly, their product. They never show it to anybody, right? They don't do they fear rejection. And that's a big one. You cannot fear rejection as a founder, right? You're going to be rejected from customers. You're going to be rejected from investors. You're going to be rejected from partners. If you're going to fear rejection, right, you only need to be right once with a company. You can be wrong a ton of times. You have one win. That's all that matters. So like for us, it's the founders that are kind of failure to launch. Don't get out there, put the cycles in to really hear from the customers and get in front of the customers. And that's where
So,
this
that's great. So, you're sitting as an observer on the board, the company's raised, let's just call it let's take it 2-stage. Let's talk about the pre-seed, which is probably 500K to a mil. What are you hoping to see, and how are you kind of advising them to burn that money? What kind of runway you're looking for? What kind of capital efficiency to get to that next, call it the 2 on 10 or 2 on 20 seed round?
Yeah, so there's a few there. So it's much more the slope of the line than where the line lines up, right? So we want to see velocity and momentum. What the ideal number is, if you give me a founder that goes from 0 to a million in 18 months versus a founder that goes from 0 to a million in 9 months, I can tell you the one that's probably going to have a better time fundraising, right? Versus the one that takes 36 months to get there. So for us, it's velocity. I rather fail fast for a founder, right? Like, don't delay the inevitable. Go out. Don't be very frantic about it. Don't be uncalculated about it. But go out there and try to make it work. Like, we've got a founder right now in the portfolio who is like just wants to get to break even on 40,000 MRR because they're having a challenge raising capital. Like, why? Like, what does that accomplish for you in the prime of your career? That now you're going to get this business to break even and continue doing this for how long? When it's been 3 years and no momentum. I've got another founder who's been at 2 million in ARR for 15 years. Like, it's time to sell. It's time to get out. Like, you've given it all. No one's going to fault you for not giving it all, but it's your passion.
Yeah, maybe this idea is not going to scale the way you thought.
Right.
Yeah.
Maybe it's not going to scale. You're not getting the resources. So for us, it's like we want to see the slope of the line, the velocity, what the metrics are. Every company is a little bit different, right? For metrics and what we're looking at. And what we do with companies is we let them really define the metrics, right? Like, within reason. If you're going to tell me NPS at your early stage is like the metric you love, I'm going to tell you, go find a new metric to love. But we let them define the metrics that work for their business, and as long as they're within reason, we kind of let them run with it.
What are the 5 metrics you really care about, 3 to 5 metrics that you really care about as a board observer for your early stage startups?
At the early stage, I want to kind of see like leads coming in, like true leads, qualified leads, conversions of that data, of those leads at some level, right? I don't care about cost of customer acquisition. It's too early. It's going to change. I don't care. I mentioned NPS. I don't care what your
like how many leads can you generate? How many demos does that result in?
How many demos can you do? How are those converting? How many customers? Usage is a key one that people don't focus on enough. Are they really using the product, right? We all have SaaS products that are billed to our credit card every month that we never use, right? Like, I want to know
your DAO kind of MAU ratio.
Yeah, I want to know, like, is this a nice to have product or a must have, right? And that's a little bit more qualitative in some ways, right, to answer that. But you can answer that in quantitative: how many logins, how many times a day, how many times a week. Like, to me, like, this one hasn't come up in a while. Monthly active users is like nonsense. Maybe for a consumer site, but for a SaaS
if it's some accounting reconciliation end of the month software, maybe that makes sense. But if
it might. But then the question I would ask is, okay, like, how many users, how much time are they spending into it? How replaceable is this, right? What were they doing before, right? Like, that's the other key. Like, how much value is this really providing? It wasn't like this company wasn't doing a month-end rec before, right? How is it feeding into other systems and how dependable they are on it? So for us, a lot of it is like very much subjective of what you're hearing from the customers at the early stage. I think at the early stage, like,
could conversion look like at the early stage, from demos to?
It's all over the place, right? Because the challenge becomes companies will define leads very different, right? So you get some companies that are really good at defining leads as qualified, right? Well, if you define a qualified lead, right, you get a demo, you should have a pretty good conversion rate if you have a product they want, right? If you have a need to have and not a nice to have, right? And we're very focused on need to have, not nice to have. Nice to have do really well in upswings in the economy. Needs to have do well at all times. So we need to have products in the portfolio. If you're defining your MQLs well, you could see 50, 60, 70%, right? If you're not, you could see 10%, right? So the question becomes like, it's a balance. So if you define it tightly, you've got less of them. So what does that say, right? If you define it broadly, you have more of them. But, like what was it in Wall Street, like pitching wood, right? What's the famous scene where like, so every company's a little bit different. And for us, it's very much like diving in and hearing what those are saying. We'll listen to customer demos. That's one nice thing. It's about some kind of the remote is you're recording more stuff now. But on the flip side, someone's actually got to listen to that stuff you're recording. So yeah, I'd say 30%, 35%, is kind of good at the early stage.
What about usage? Are you kind of looking for some percentage are daily active of all the users? So it's kind of, you sign up and like, what's your 1 day, 7 day, 30-day retention?
Yeah. I mean, again, I think it not only usage, additional users being added onto the platform, assuming it's a kind of user-based platform, right? If it's more of a plumbing platform that, it might be data going through, connections, things of that nature, but relevant to the product. To your point, if you're doing a month-end accounting rec platform, it might be less usage. But if it's month-end, how many of those companies are actually logging in and doing it every month? How many hours, how many people, how sticky is the product? If there are reports going out, how many reports are being generated from the platform? Things like that, where you kind of have to look at, I think, every tool a little differently and say, okay, what are the kind of key aspects of my tool that make it valuable? So, if it's an accounting software, it could be connections into bank accounts. How many transactions are coming in, right? If a company's got 100,000 transactions coming in to some accounting solution, I'm going to say it's a heck of a lot more valuable to that company than something that's have 100 transactions coming in a month. Dependency is a big one for us. We've all have it, right? I use a platform that I've had for nearly 18 years, a high-rise Basecamp, to track. It's like a little bit of CRM. We also use Affinity. Never getting rid of those platforms because it's got so much archival data in it for us.
Affinity is so expensive. I haven't pulled the plug on that yet.
It is, but it's pretty good.
Yeah. Pulled the trigger, I mean.
I'm happy with it. I mean, I like the fact that it integrates your email box and extracts everything out of there automatically.
That's kind of cool.
Go negotiate with them. Tell them you'll give them a few plugs on the podcast.
Yeah, there you go. Yeah, I'll invite the CEO to the podcast.
That's,
by the way,
100%.
Yeah, exactly. That's a good idea. All right, let's wrap up with a rapid fire. So speaking of metrics, what's one metric that founders overhype?
NPS at the early stage. I mean, you don't have enough customers. Half of them are your friends. Like, I don't care. Like, I think that one, and then CAC. I mean, I kind of said on both. Like, cost of customer acquisition, like, it changes so much over time. Channels are going to change. How are you really accounting for like all your time as a founder you put to this, landing this lead? So those are two that at the early stage, I'm like, you're fooling yourself at this point if you think, your NPS means anything when you got 12 customers.
What's one metric they underappreciate?
Qualitative customer interviews and customer feedback and customer focus groups. And I don't know that they underappreciate it as much as they fear it as a whole.
Get out of the building, as Steve Blank said. I'm sure you're a student of him. At least read his stuff. Last founder deck that really impressed you. What made it stand out?
I don't know. I saw that question. I saw you were going to ask me. I don't know. I honestly, like, see so many founder decks.
How many founder decks do you think you look at, like, on a daily, weekly, monthly basis?
Well, we see about 900 to 1,000 deals a year. So
yeah, that's a lot.
You can back into that.
I probably look at, I estimated I probably look at 200 or 300 a month, maybe up to upwards of 400 or 500 a month. It's a lot.
It's and you're
basically taking 30 seconds to like, do I want to meet this person or not?
100%. And you see, what I miss is like the one pager, actually, the little like that had some like little story to it, a little like you can do enough
summary. That's what I tell founders. Like, if you want to stand out, send a little one pager.
Yep, because all the decks are like following the same format. They look the same. Like, you can debate, does the founder
market,
go in the front,
right time,
right? Especially if you're going through an
traction
incubator.
Up and to the right.
If you're going through an incubator, they're all like the same deck, right? Like,
and YC has all the same decks. Techstars has all the same decks.
So to me, like, they're all, and if your deck doesn't look good, something's wrong too. Like that actually, I'd say the question is the opposite. Is like, to me, like a yellow flag is like when a deck actually
really
doesn't
complex.
Look good. Super complex, a lot of words, not formatted well. Like,
yeah,
come on, like there's got to be easy. There's easy tools, or if not, go on Upwork and hire someone for $300 to make the thing look pretty, right? Like, there. So to me, like, it's more of what stands out is the decks that don't look. To me, they're all, most of them look good. Luckily, I guess.
Yeah, a company you pass on and still think about.
Posterist from back in the day. I loved the product. It was a blogging tool back, I think like 2007, 2008, 2009 time. This is when like blogging was super hot and comments and email newsletters. I gotta go back and look because I have like all my emails, but why we passed. I think it was valuation. Ultimately, they were acquired by Twitter. I don't know how good of an outcome it was, but I loved the product. It was like, part of me, I like to invest in products I like Clout, great example, product I loved. Crimson Hexagon, product I loved. Respondology in the portfolio now, product I love. Vitally, beautiful product. So that was one that I loved what they built over there and ultimately passed on it.
So you pass on valuation. I mean, how often, you said you backtested this. How often did that, work out for you where you're like, hey, I should have actually invested or not invested. I made the right decision on valuation.
I don't know that I have a good answer for that one because it's always hard to tell, right? There's been I'll give it the answer a different way. There's been companies that we've done secondary sales on. So we'll do secondaries when it helps the company. We're never the fund that's going to go on to one of these sites and post, we've got shares in XYZ company for sale.
They're raising a Series B or C round and like, hey, does anybody want to sell more shares? Yeah.
Right, exactly. There's a tender happening, or there's some investor that the founder wants to get in who wants more, and we'll sell some. And there's been instances where we've sold, and then 3-4 years later, the company is sold for the same price we sold at. Right, so
you just generated a higher IRR for your investors right there.
Exactly. And that's the thing. So the industry historically hasn't looked at IRR. We've been pretty focused on it. So we have a metric that if there is a secondary available and we have a 10x money on money return and at least 100% IRR, right, we will consider selling something, usually a third to half of the shares that we're holding. Yeah. 100% IRR. And both those numbers are a little bit arbitrary, but they sound good.
10 and 100 is easy to remember.
Right. But the IRR component of it takes into time, right? Because at the same price a year later is not going to be 100% IRR. So we're actually very much focused on IRR, not just multiple of money. Also.
Right, because that's how institutionals will evaluate you, not just the TVPI, not just the DPI, but they'll look at the IRR. Yeah.
Getting back to kind of our view around looking at this as not just a GP, but an LP.
Right. Maybe you could talk a little bit more about, last question, and then we'll kind of wrap up, kind of how each informs the other, right? Being a GP and an LP, and like how you approach each differently.
Yeah. So, I mean, we are an LP, I think I mentioned about 12 funds and incubators. The reason we've done that is to support the community, deal flow, deal collaboration, deal sharing over the years. I think we get to see a broader trend in portfolio. So how our fund is performing versus other similar funds within the asset class. Liquidity has been a challenge the past 3-4 years. Was it us or was it the industry? Well, we could also go on PitchBook or some other data source, I guess, and say it was just the industry without actually having to be LPs. But I think it's, when you're an LP in a fund, it's a little bit more collaborative with that fund, right? If they send us a deal, we're already in that deal, right? Or if they're assuming they're in it. I think it's also really much given us a different perspective from investing because we're looking at it from like, is this going to generate returns, right, for our investors? And maybe a deal that isn't going to be a home run, that's going to be a 6 or 7x is super interesting to us because we think it's a little bit low risk. I kind of alluded to earlier, like we're doing a little bit barbell. So this fund we're doing seed, the really early stage stuff, which we've been focused on, but we're doing some Series A stuff, higher valuations, real revenue. And the idea there is quicker time to liquidity, right? That's an LP view, right? In a lot of ways, or from a kind of LP lens is like, how do we get quicker liquidity to our investors and to ourselves? Maybe not the higher returns, maybe not the higher money on money because they're a little bit later stage companies at that point. So the GP carry would be less, but we're making it up on the LP side. So I think that's kind of where it plays in. So we're very much focused on, we've done recent deals where we're much later stage for us, Series A, Series B, one 100 million plus raise where we put in capital. Another is a $6 million run rate business right now that we're doing that traditionally we wouldn't. And I think that has been shaped from what we've seen from the funds that we're invested in, the lack of liquidity. How do we evolve also on that?
Well, also the QSBS clock doesn't typically even start until Series A, right?
Well, that's a whole nother piece of the, everyone doing safes versus, I typically like to ask the question, especially a company that's doing $2, $3, $4 million safe, right? Like, why are you doing a safe, or why are you doing a convertible note? I mean, you don't see too many convertible notes, and I hate the answer 9 times out of 10. 9 times out of 10 is it's quick and easy. Well, go work at McDonald's if it's quick and easy, right? Like, nothing's going to be quick and easy. I promise you one thing: everything's going to take longer and cost more than you expected for the next 6, 7, 8 years while you're building this company. So do it right. Do it the right way the first time. So I think that's a kind of, besides the little F-bomb there, a good place to end it on is like,
we can F-bomb on this, but yeah, I appreciate the time, Jay.
It's not going to be quick and easy, but hopefully you're having fun and doing something you love at the same time.
Right. I know it was a great conversation when I got, I didn't get to all my questions, and there's probably like half of the questions we didn't get to. Where can folks find you online?
Twitter or X, Zelkova VC, zelkovavc.com, zelkovavc.com. We weren't really thinking when we had to give people the email address over the phone about what the name of the fund would be. Jay Levy, letter J, last name Levy at Zelkova VC.
Thanks so much for coming on.
Awesome. Thanks for having me.